But
I mean, the good thing is it's only 90 minutes, right?
it's 90 days is how long the program is. But yeah, usually it's like hour 15.
Oh, okay. So it's like 60 minutes for 90 days. Okay.
Yeah. Yeah, one of the most inspiring things is looking at the previous recorded lectures where my face is just a little bit rounder. But
There you go. Okay. Yeah. Okay, let's just get started. So today we're gonna do lecture, and then I think there's still gonna be some time to go over your PE and VC project. So after lecture, I'm gonna give you guys at least 20 minutes for any questions that you might have for that project, and then submit, I guess, like a draft on what you're thinking before the end of the day. That way, I know you guys are heading in the right direction. So yeah, we should have enough time, like at least like 20 minutes or so, to do a quick breakout room and for you guys to work on a draft and submit your draft on Canvas. And it won't be like a draft of the whole presentation, just like kind of like, just like a one pager on what you're thinking and which direction you're going with your PEVC project. So that should be good. Persia, you always have a lot of family members. Pretty funny. Do you ever consider doing like a virtual background? You know, you can
I
create a
don't know.
background,
I've
right?
never tried it.
Oh my gosh. Yeah, look that up. So you don't have so many people like walking around in the background all the time. Okay, so venture deals. This is, I mean, today lecture is gonna be pretty fun. We're gonna go over whatever remains of the venture book deals or venture deal book. I'm sorry, and everything except for the equity crowdfunding part. And then we're gonna go over a little bit of financial modeling, which is gonna be pretty exciting. But this time not using the comp method, just kind of building out your own assumptions, and how to use financial statements to assume growth, right? So we're going to go through that exercise a little bit and then talk about the difference between IRR and cash on cash return and those types of concepts. So let's just dive in. So what is the beer test? The book talks about the beer test. The irony of it was we had a beer last night, so lie, yeah.
It's whether or not the relationship is good enough to want a beer with them.
Yeah,
Like, especially since later down the road it's gonna be harder. And if you
Mhm.
don't want to have a beer with them now, the relationship's not gonna work out, most likely.
Does anyone know the airplane test? Has anyone heard about that? Lai, have you?
Isn't it whether or not you're able to sit on an airplane flight with them for hours?
Yeah. Like, can you tolerate this person if you were stuck on an airplane for 4 hours or 8 hours? Oh, Persia, you could have your camera on. I wasn't trying to imply that you should have it turned off because of your background.
Oh no, it's okay. I'm trying to figure out how to do the background. I found it though.
Oh, okay. So Lai, yeah, that's correct. So this is just kind of a quick litmus test, especially like the seed and pre-seed, pre-series A, like that's all they care about. Oftentimes, are they smart and do I like them enough? It's in a lot of ways the way I see it, more important than your idea at that stage. Like, do they like you or not? When I talk to sellers, I think statistically, I just straight up don't like 1 out of 10 sellers. And no matter how good the company is, like I just would want to kill a deal. And I just tell my team, like, I just don't like him. I don't trust him, whatever he or she's saying. So if you look at our deal flow, I would say about 10% of our deals get killed just because of that. And there are certain, I guess, like intuitive metrics that I look at. So one's called revenue to ego ratio. Can anyone take a guess what that is? Obviously, right? Like how big their company is relative to the size of their ego. And it's like they have like the biggest ego in the world, and they've worked on this company for 30 years, and it's like they're doing like 5 million a year. It's like, dude, this is ridiculous. Like you should be doing 5 million in revenue by year like 5. Why is your company so small and your ego so big? Another thing is like I look at like what I call bite to bark ratio. Is someone just so much of a talker than they are a doer? I just can't respect people that just talk a big game and don't execute. So for me, it's like if I have to work through a 10, 20, 30, 40, 50 million dollar acquisition and the seller is like that, then that's a no-go for me. Same thing with like investing in startups or even sitting on the advisory board. I look for consistency, and if I can't find anything good in there, it turns out really sour, and I normally kill the deal. So how do you become likable? I think the best advice is just be you. I have like, so for me it's like very problematic sometimes because I can only show sides of me that are believable, right? So like last night, for example, I shared the fact that I moved back from Korea at the age of 16, and I had to like learn and relearn my Korean and get rid of my accent, right? But for people who like just met me, they don't think I was ever a fob. But if I meet my high school friends, they're oftentimes like, dude, like there's this other Kevin Hong dude, like he was a fob, he couldn't speak English, but that was like me, right? But most people don't find that believable, or the fact that I lived in a band for like 2 years, right, to grow my startup. Like I can't share those stories. Otherwise, they're just going to be like, oh, dude, this guy just like exaggerates and tells tall tales and whatnot. So my advice is like be yourself, but it's like a first date, but project what like a stranger would also find believable and comfortable. So you don't have to go too deep. But it is very important to be likable. Any questions about that in terms of like VCs and talking to investors, perhaps at a networking event? And actually, like if you click well with someone, don't hesitate to be like, hey, let's go grab a happy hour or a lunch or a coffee and whatnot. Don't keep it too formal if you're not a formal person. It is really, really awkward. Even in the finance space, like no matter how strict they are, people want to feel comfortable. That's the most important part. So don't forget that. We do get a lot of applicants, for example, for our PE fund with a lot of interns, and they try way too hard to be formal, and it kind of turns us off a little bit. It's not a good cultural fit. Should you ask for an NDA? Any questions about this? Or any comments? What do you guys think? Do you sign an NDA before you go to a meeting?
Depends what the meeting's about, I would imagine.
Let's say like, in most, like you're raising a seed round, I guess like you're doing like $1 million in revenue. You're trying to raise like, let's say $500,000 at a $2 million valuation. At this stage, like, would you ask for an NDA?
No.
Why, Logan?
Doesn't seem like enough money's being thrown around.
Oh, just for that?
$500,000?
Yeah.
Is that what you said for the funding?
Mm-hmm.
Yeah, that doesn't seem like a level where you would, need an NDA involved. Oh, sorry. I imagine once it gets a little bit higher risk, maybe some NDAs might be thrown around here and there, but
yeah, your rationale is quite solid. However, there's a little bit of a different nuance to that. Anyone else want to take a stab? Yeah, Lai.
It's because if they sign the NDA, they can't talk to other investors about your idea.
What page was that? Page
Is
245. No, I'm just kidding. Yeah, that's really good, Lai. So I think that's a really good textbook answer. But if let's say you're a VC, just put it in your shoes in a VC. Of course they want to talk to other, VCs, but like, you don't necessarily want VCs who just talk to other VCs. Like if you're dating someone and you ask that person on a date, you don't want to date someone that has to ask their friends all the time. Like, hey, should I date, Joey or, Sam or Sarah or Michelle? Like, you don't want that. You want investors that make their own independent judgment. And you should get turned off like when you're trying to raise money and a VC or PE investor says like, oh, who else is investing in this? Because they're looking for social validation, right? They're looking for confirmation and momentum, but it's like, dude, like, I don't want to tell you, like, why don't you tell me your decision and then I tell you? Like, yeah, I don't know. You have to kind of think of a way to circumvent that. But yeah, the book, it's right. Like VCs always share pitch decks, even with entrepreneurs that have been successful to get the other side's perspective. But I think more importantly, if you're a VC, you're looking at hundreds and hundreds of pitch decks a month, if not thousands. And if you're that one startup that says, hey, please sign this NDA before I send over your pitch deck, there's that reason alone could be a reason just to kill the deal. Literally, I killed a deal last week. 90% of it was just because like their CFO just wanted to change up the mutual non-disclosure agreement. He's like, can you change this one sentence? I'm like, seriously, it took you 4 days to change this one sentence? Like, you're gonna waste my time over this? And I just like, I didn't kill the deal like officially, but I just stopped pursuing it because it makes me think on a tiny ass, or sorry, excuse my language. It makes me think on a tiny, like, $2 or $3 million revenue generating company. And it's so small. And it's like, if this is gonna bother you, think about how the legal transaction costs will add up if it just continues on with this momentum. There's no way we can get a deal done because on a tiny deal like that, I'm gonna have to pay double, maybe like $400,000 on a $10 million deal, opposed to $200,000 on a $20 million deal, which I'd rather do. So it leaves a really bad impression, especially when the rest of the VC world is basically very open source oriented, and it's not customary to sign NDAs. The second thing is, if you're raising early stage companies, you don't even have proof of concept, and you're not scaling yet, and you haven't really penetrated various markets. So you kind of come off as a little bit aloof. And the chances of someone stealing your idea without having a proof of concept, whether it's a huge corporation or another startup, is almost next to nothing. People only want to, like, remember when Zoom was, creating a lot of headlines, and then Facebook said they're coming up with their own Zoom like last year? I don't know if they did. I don't think they did. But, they were gaining so much momentum. I mean, it took Facebook to initiate something like that, not until they hit something like Zoom hit something like $50 billion in total enterprise value. Or when Facebook came out with Facebook dating like 3 months ago. Did you guys see that on your Facebook filter? It's like Facebook dating. It was ridiculous. Huh?
I don't have a Facebook, so no.
Oh, okay. I rarely go on Facebook. The other one was, let me see here. Yeah, when Facebook bought Instagram. This was until Instagram hit like over $1 billion, and Facebook came. Like Instagram came out with those really short reels after TikTok became like a huge company, right? And usually, when you're a second mover, you come to the market significantly later, even if you have ginormous resources, because you're always following the market. And when you follow the market, you want proof of concept. So only you are going to be the one that's taking that risk, putting your job, speculating on your idea, and is passionate about your idea because you do research. So the chances of them just copying your idea, especially when you're an unknown entrepreneur, is so rare. It's just one in a. If it ever happens to you, please hit me up. That would be like a case study in itself, and I will create a case study and submit it somewhere. Don't email bomb VCs. I think this is very self-explanatory. I think it's good and it's bad. I mean, you can actually. I don't think it's too bad of an idea. But if they remember you, and then they didn't like you, then this could work against you. I would kind of pick and choose to reach out to VCs and start adding them. If you can get some kind of, I guess, response, maybe like a 20-minute Zoom call or even like a response, and add them to an investor update on a monthly basis. So I think I shared with you guys that. It works really, really well. You start building a organic relationship. I've had a couple investors that I've never known that I just add them to the newsletter, and then they just really, really like it. So that's not a bad approach. But don't spam them, just for the sake of a meeting. A better way is to just add them on the email list and just giving them, updates every now and then. No often means no. Can anyone remember what this means from the book? Except lie.
When VCs are not like that interested, go just find some other VCs and another one that are interested. So when they say no, they probably stick with the no. Is that it?
Yeah, it's pretty much it. I mean, so VCs and PE firms, normally they have like a investment committee. So it's like a managing partner, vice president. And then remember we studied the funds, and each fund has their own deal flow, right? Healthcare sector, fintech sector, someone for international. And then every week or every 2 weeks or once a month, they'll usually have like an investment committee meeting. And it's like a pass or no pass, pass or no pass. Like every single VC and PE firm that I talked about, generally, if they're a little bit larger, they have that type of structure usually. And then the typical protocol is to make decisions at that spot, and for them to like revise that decision and override a previous decision, it's normally no. And then there's also buckets of like reach out and contact them in 3 months or 6 months. When they mean no, it could mean a strict no, but it could not mean a no as well. But the important takeaway is that oftentimes it has less to do about you and more about their investment thesis. So sometimes the no is just because like they're on their last leg of dry powder and they want to save it for a really, really amazing company. Sometimes a no could just mean that, they have invested in a similar company and they don't want a conflict of interest when they have two companies that are very, very similar in their portfolio. They might just want to even diversify. Sometimes you might be a US company, but they might be over invested in the US space. One of the more interesting things that I got turned down by was that one of the investors hit their quota for solo searchers in my space, because I'm a solo co-founder, right, in this space. And they couldn't invest in more solo searchers because they were maxed out. And then they had to only invest in partnered searchers now. So I told them that's like a really dumb reason. Like, why would you invest in two mediocre entrepreneurs when you have one great entrepreneur? You never do that. In sports, you never trade a great player for two good ones. You never do that in almost any sport that I'm aware of. Do you guys agree with me? People who follow sports in general? Yeah, you never trade Michael Jordan for like Scottie Pippen's great. I don't want to throw him under the bus. Like two John Starks. I don't know if you guys know that era, but like you just don't do that. Or like a Kobe Bryant for like two Derek Fishers. You just don't do that. It's just really, really dumb. So I sent them that email response, and they're like, "This is the best response ever. Let me try to override this with my LP." So he went back, talked to his limited partners. I don't know what happened because they called me back like a month later, but I was already pretty much done with fundraising. So it was unfortunate, but yeah, it's I mean, I don't know. So as a sales guy, sometimes the chase starts when they say no. So it's really hard for me to think like no often means no too at the same time. But just be very discerning. Oftentimes it's them, not you. Don't ask for a referral if you get a no. Does anyone have any questions about this? I think this is pretty self-explanatory. Okay. So yeah, so I think for this one, I think you just have to understand that, like, you know, if a VC said no to you and they talk to their VC friend and it's like, all right, we're not investing in them, but you should, it just makes the situation very, very awkward. And the other friend's like, well, why aren't you investing in it? So, okay. Don't be a solo founder. Why would this be, guys? And and the book mentions there's exceptions to this rule. If anyone wants to take a stab at it or guess, that'd be great too. But yeah, go ahead, Logan.
I was going to say just the responsibilities to be a solo founder, like a, sole founder of a business. It's just a lot to deal with, like in one fell swoop, so I think it'd be better to just kind of diversify, maybe have, maybe like a LLC of some kind where it's just, multiple founders involved, just to handle all of the different firms and meetings and stuff you got to go to.
Yeah. So, no one could be like a great coder, sales guy, operator, finance guy. It's just so difficult. So it is very, very rare for solo founders to get into some of the top accelerators like Y Combinator or 500 Startups, Techstars, etc. There's such a huge preference for co-founders, and even in the PE space, like they want partners that have complementary skills. They don't necessarily like it because even if you are really good at everything, the problem is you're constantly trading off what work to do, and there's always an opportunity cost to that. So if you can delegate some of the stuff, it makes it so much easier. But solo founders do get funded every now and then, and they're normally incredibly good. What are some of the exceptions the book talks about? Lai, do you remember this one? I bet you do.
I think the exception was a repeated entrepreneur.
Yeah, normally it's a repeat entrepreneur, or someone who has a lot of experience or just really, really good connections. Yeah, but yeah, me personally, I do. I'm an advisory board of a solo founder, and yeah, I think he's definitely struggling a lot just to keep the rest of his team motivated. And being an entrepreneur is a very lonely trek. And a first-time entrepreneur is more susceptible to the ups and downs significantly more, right? So someone who's been in the game like 10, 15 years, you're just already tested, at least on the emotional side. So it wouldn't be an emotional roller coaster, and you won't like give up halfway. So they have a lot of peace of mind with that. Especially like American entrepreneurs, particularly, they're definitely all about entrepreneurs that failed as well. Very different from Asia. Like Asia's like, you brought great shame to my portfolio. Never again will I invest in you. Very, 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 very strict. So it's very different in Asian culture, I think. And Asian investors have somewhat a different perspective. Not sure about Europeans as much. I haven't really pitched as much, but I think the Western European is very similar to the US. Sometimes different terms, but generally it's good. And oftentimes they want more control, if anything, European investors, from what I've noticed. But this is just me kind of talking about my anecdotal experience, so take it with a grain of salt. Patents. Let's talk about patents. This is one of those things where first-time entrepreneurs get really, really into. But what are your thoughts, guys, on patents? Good, bad? Should you pursue patents? No, yes. Logan?
Like I said earlier, it kind of comes down to, what it is you're working with. And also if it comes to, I thought this was asking about like the pitch meeting. It shouldn't be like 15 minutes of your 20-minute pitch meeting or talking about your patents. So I feel like they're important in the sense of like, you could provide some form of exclusivity, like only, I can make this, you know, or if you buy the company, we can make this. So I would say they're important depending on the industry.
Hmm. Has anyone ever filed a patent before? Or ever talked to a patent lawyer?
I think I've filed for a trademark.
File for a trademark?
Yeah.
Yeah. So what was that experience like? And how would you make it robust, Logan?
It was pretty straightforward. I think it was just you go online, what is it, to the US patent or whatever service.com, and you just pay some money and they're like, all right, we're going to file it. We'll wait on it for a while, but you know, your patent pending or, you know, trademark pending, whatever. And yeah, then it just shows up someday. They'll tell
Hmm.
you, yeah, you got it. That was kind of it.
That's interesting. So I've never filed for a trademark, but I filed for a patent, and I talked to a patent lawyer, or I didn't file for it, but I talked to a patent lawyer to look at options for. That was just way over ahead. I had like two PhD friends from Yale, and they're like, "Hey, you know, we're interested in having you as CEO at like one point in my life," and it was about quantum computing. I had no idea what this was. And they're like, "Hey, we need you to file a patent." All right, let me check this out. I don't even know what you guys do, but let me just check this out. And the problem with patents is that you have to figure out every permutation of that code to protect it. So it's like your code does like A, B, C, D, but if another company does like A, B, C, D, and then E, then it's no longer protected. So each patent you have to file for every single permutation, and that's how the patent gets robust over time. So you have to constantly come up with different ways to protect it. Because if you look at like, remember the Samsung versus Apple situation where like touchpads and they were having all these like issues with Samsung, being accused of copying Apple, which I completely believe they did. But they were just slightly changing all these different pieces on their Galaxy app, rather than opposed to the iPhone. And if you think about it, instead of having like a button over here, you just put it over here. Instead of being like one click, you just make it 3 clicks. There's so many different ways to circumvent that. And if you're at a seed stage and you're spending all this money pre-proof of concept, filing patents, you're just going to look like an idiot. You're like, the market's not even proven. Like, why would anyone copy this idea? Now, to Logan's point, if you have something really, really robust, like some kind of advanced medical technology with the right formula, that is actually patentable, right? But a freaking feature like on a sales analytics tool, which has some kind of predictive analytics feature, like everyone's trying to do, right? It's not really patentable. So you could mention that you are considering a patent, especially when I think a common logical fallacy when this happens a lot is when a VC asks like, "Oh, okay, is Apple going to copy your idea? Is Google going to copy your idea?" And it's like, "No, we're going to file a patent." I've seen a lot of first-time entrepreneurs say that, but then you kind of dug yourself your own hole there, right? So you can't really answer that question with a it's a dumb question with a dumb answer. The way I see it, when it's like a first-time investor asking a first-time entrepreneur, and they both like are at a networking event, like holding that cocktail, and like both acting like really smart, but neither is really smart. The investor for asking that question and the entrepreneur for answering that question in that way. But I see that again and again. So in regards to patents, tuck that to the side until you hit scale. At least I would say 5 to 10 million in revenue. Then you can start exploring those options. And once you're profitable, that's when you can start adding some defensibility to your product over time. But in the beginning, pre-proof of concept, it's nothing to focus on unless you're in some medical field or quantum computers or something like really, really high tech and robust. So yeah, so this was a really good quote. Most VCs will tell you that they've made money on grade B ideas with grade A teams, but that many A ideas were left in the dustbin due to a substandard team. So that is true. You see the market, right? It's not necessarily the best product that wins. It's normally the best team, the best company. that wins, right? So oftentimes we see, B products get considerable market share. Like for example, maybe MySpace, right? Wasn't that robust, but Facebook, came around and changed the game. Like WebEx, right, from Cisco, was okay, but then Zoom came around, and thanks to COVID, right, it accelerated its growth. So oftentimes, companies that were there first tend to grab market share, but over time, right, users are able to discern what the superior product is. But the problem is if you're too product focused, then you're never going to be able to scale. Now I know a friend that's been working on his startup for about 2 years. It's like a LMS software, like kind of like a Canvas, and he's never shared with me a demo for 2 years at all. And he keeps fixing the bugs, changing it, etc. One thing is that if you ever decide to launch a software company, you have to understand no matter what, you're going to launch and there's going to be bugs. It's so inevitable because starting from like payment systems, everyone uses different payment gateways, different landing pages, different ways of integrating, the client interface and yours. There's going to be different users using the account. They might, go in and break things. So it's almost impossible to launch with no errors, right? And I think a lot of engineers fall into this problem. And even if you're, starting your own clothing shop, I mean, you're gonna have logistical errors. Nothing is perfect. So if you guys never read the book, The Lean Startup Methodology, it's a good book if you're not familiar with entrepreneurship. It's a horribly written book that I couldn't finish like 5 times, but I got to the furthest I've gotten was page 100. But it's so basic that for someone who doesn't have a strong sense of entrepreneurship or is just learning entrepreneurship, it could be incredibly helpful. So for some people, it comes very intuitive, right? So whatever you do, just spend the least amount of money. That's minimum viable product, right? Creating a feedback loop with your customers. I mean, I have no problems like showing all my errors and hiccups and co-building and fixing those errors with my customers, even when they paid for the product. I have no problems about that, right? But some people, especially I notice that the smarter they are, they don't like to share their mistakes because they're so used to being that perfect grade A student. They don't want to be criticized. They take it so harshly. So for folks that are kind of in that situation, it's very tough to be an entrepreneur. But I think you have to just go out there and share that feedback. And the good thing about the customer is that if they're able to give you feedback on all your bugs and errors, what they like, what they don't like about the product, you end up building a superior product, and the customer feels ownership that he or she was able to build the product, and then they brag about it to their other friends in that industry, and you're able to organically scale. So there's this one company that I work for called Vista Group. They're so good at doing that, and then their customers will quit their job and become account managers at that company. That's a really good sign of a strong product when your customers become your employees, or if you're doing really well, when your investors become your employees. That's a hallmark of a great entrepreneur and a great company. And when I see that, which almost never happens, like I'm very, very impressed because I know how difficult that is. Here are some things that you just need to be very careful of. What's liquidity preference, guys? Wasn't this on the midterm? It's basically when you exit, right? Investors have X amount more, right, of the benefits than you do, right? It's like your return becomes higher because they need to make a minimum of X percent or X times higher from that initial capital investment before you get any of the proceeds, right? So early stage liquidity preference is normally kind of where the battle is fought. We covered that. Seed deals need to be very careful with the terms. And what were some of the things that you prevent that? What are some of the clauses on the seed deals that you're able to prevent bringing in bad investors that prevent you from selling a company? You guys remember? Drag along clause. Yeah, Vince, go ahead.
Yeah, the drag along clause, so that people who have majority can basically pull the people who don't have that much, and you can sell.
Mm-hmm. And then other stuff like co-sell agreements, right? You can prevent, you know, maybe certain lousy investors, or maybe your aunt or uncle that is rich and invested in you, but are not as sophisticated to prevent yourself. So make sure, you know, you tighten up the screws on that. And then mid to late stage, it's all about finding the right board members. It's almost inevitable that you're going to have to share your board with the lead VC. That's just customs. It's just generally accepted, unless you're like growing like gangbusters, like Mark Zuckerberg, and you're so hot that you know you can do whatever you want, which is crazy because I think Mark Zuckerberg still owns like more than 50% of the company, which is so incredibly rare. So let's see here. How are you doing on time? Okay, 9:40. So let's talk about indication of interest, letter of intent, deal structuring, working capital, and escrow account. But before we do that, can we just take a quick 5-minute break? Just to use a restroom. Okay, cool. So we'll circle back in a second. Hey, Logan. I love how Logan has his camera off because he might be just playing music on from YouTube. Can't tell. Where's your guitar? Oh, okay. Maybe that's just a prop. Cool. Is everyone back yet? Or you good? Okay. Cool. So yeah, let's just talk about a few concepts here. So I guess, you know, let's say we're gonna switch over to our investor hat now, right? That's what we do in this class. We go back and forth. And I guess even before an indication of interest, what do you normally sign? What's an indication of interest?
Like that'd be like a down payment for a house.
Down payment of, I guess it could be. I never knew you put an indication of interest for a house. I guess you do, right? Yeah, you put that in there, but yeah, it's very similar.
Earnest
And
money.
Persia, go ahead.
Earnest money, like a deposit.
Yeah, it could be. Yeah, it could be a deposit. But let's take a step back here. What happens before the indication of interest? So let's say you're a VC or a PE firm. You looked at the pitch deck. You're like, oh my God, this is amazing, right? You talk to a couple of your VC associates or VPs, and you're like, guys, we gotta pursue this deal. What do? You call the entrepreneur, right? So let's say Aman, right, is the entrepreneur, right? And to get the conversation going, Enrique, what are you gonna do? What are you gonna do? Like, you know, what are you gonna ask for Aman? You just saw his presentation. You're like, oh my God, this is awesome. Aman's selling the most incredible widgets of all time. And then Enrique, you're a VC. Or let's just do PE now. We talked too much about VC. You're a PE firm. You want to buy Aman's company because he makes the most amazing widgets. What's intuitively? What are you gonna want to do after that? You saw his website, his LinkedIn. you saw his 15-page pitch deck. I think you're on mute. Vicky, you with us? Okay, let's yeah. Let's switch over to Vince. Sorry, Enrique, maybe you could fix that and we can come back to you. Vince, yeah, so you know, you're interested in investing in Aman's or doing a buyout for Aman's venture. And you talked to, you know, Lai and Logan a little bit, you know, they're like, oh dude, go for it. What would be your next step?
Is that the letter of intent next? Or
No, don't even look at don't even
oh,
think
okay.
about this. Just
If,
intuitively, what do you want to do?
I mean, if I'm already interested in everything, and I've already seen their pitch deck and everything, I mean, I want to get more involved. Maybe work with work with their investors or get kind of some
Nice.
investors together or something. I'm not sure actually.
Negotiate.
First, you're gonna negotiate right away.
Yeah.
Well, what if? Well, are you gonna be that naive and believe in a 15-page deck and be like, oh, dude, this is legit. Let's throw in $30 million. You wanna? What do you want to do before you negotiate? You've never met Aman. Like you didn't even knew this guy until like yesterday. You go straight to negotiations, or maybe not, right? So what you want to do? Logan?
Show interest in like purchasing it, I guess. I don't know. Without like a letter, I don't know, like just the indication.
You could do that, but what's more important than that?
Before you negotiate, you have to investigate a little bit.
Yes, trust but verify, right? You want to see his tax reports. You want to ask for his contracts. You want to look at his financial models. You want to check if it's like, you know, employees that really work there, right? I mean, there's been incidents in Silicon Valley as well as the PE world where people like from overseas, they settle in the US for a couple of years, raise a ton of money, and then just like run away. It's not uncommon. That's happened a few times. Even one of my investors just 2 months ago, he lost like $1 million because one of the VC funds like just ran away. That's what happens when you get an Harvard MBA. You either become really successful or commit fraud. You never hear someone from UChicago like Booth MBA like sex scandal or Enron or something like that. They're all from Harvard. It's pretty funny, and they're rarely tech entrepreneurs. It's people in finance, because all the work they make you make bad moral decisions. I guess I don't know what it is, but anyways, it's just a joke in finance. So you want to be able to trust Aman's numbers, right? And I think we talked about this founder optimism. Remember that, guys? When founders make projections, they're a little bit more optimistic than they are. And in order to facilitate, right, these due diligence processes, you'll normally start with a mutual NDA. So it'll just look something like this. I'll just share with you a very standard mutual NDA that is very common in the VC world as well as the private equity world. It's just normally like a 2-3 page contract. I'll just post this on the Canvas, but the terms are pretty straightforward. Everyone's seen this. This is produced by Org, I think one of the biggest law firms in Silicon Valley, but this is also very prevalent in the VC space. So you just have someone sign this, and this is very standardized. And that's where I was like really put off. It's like, dude, this is like the first time you've seen this. And then I killed the deal because it was ridiculous. Like, why are we disputing something that is standardized, right? So you'll sign this. then you will normally ask for financials, contracts, if the company was registered, where it was registered, just very basic stuff. And then Persia, what do you do after the numbers look good?
Negotiate.
Yes, and that's the indication of interest. So I'll show you guys what indication of interest would look like. So just bear with me a quick second here. And negotiation, I think, is the most fun part. I tend to notice that it's oftentimes like, for some people, the worst part of the deal, because they get very timid about negotiations. So I think I don't think I shared this with you guys yesterday over drinks, but one of my investors were like, dude, how do you get such good deals? And I told them, did you notice that 30% of my deals are from Canada? Canadians are such bad negotiators. I don't know why. They're just too nice. Like, no, your company's not worth 30 million, it's worth 22. Like, all right, that makes sense. What the hell? It's been pretty interesting, and I guess it's because, like, in American culture, we deal with a lot of entitled people, and maybe Canada doesn't have that. So it's like we tend to be in an environment that you have to negotiate a bit more. So let me just kind of delete the names here. Realize they're still there. Okay, so let me share my screen. So in the indication of interest, so some companies, by the way, they don't do an indication of interest. They go straight to LOI. It's like take it or leave it. And what would be a pro of going straight to LOI versus having like one additional step? Like, what's the pro and what's the con?
I feel like the con is that it's legally binding, right?
It's not necessarily, you could still kill a deal under LOI, but at the LOI stage, it gets serious. So the seller might ask for like a deal cancellation fee. Like, for example, if it's like a really hot deal, the seller might ask for like, hey, I can't spend 2 months, 3 months going through due diligence with you. If you don't go through with it, you have to pay a $50,000 penalty. That's not uncommon. So that is somewhat legally binding, right? It's situational, Persia, but not necessarily the case. But you're right. It requires a much larger level of commitment. But what are some pros going to the LOI stage?
They're excited to work with you, at least to some degree or another.
It could be, but you can still be excited, even in the initial pitch deck meeting, right? It shows a level of seriousness, but what else is very important? What's very important in a deal besides deal price, deal structure? What else is very important if you're a VC or a PE firm? Who's your competition if you're a VC or a PE firm?
Other firms,
Other what firms?
other VC or PE.
Other VC firms, right? Or
Yeah.
other firms that could buy that startup, right? So what does that mean when the deal, goes on for a longer period of time?
Could it be that it becomes like exclusive to you after the letter of intent?
Mm-hmm. So you're preventing that, right? But if you don't sign in the letter of intent very quickly, what would be the opposite of that, Persia?
Then it's not exclusive to you. There's other people that are like willing to jump on it before you get the chance.
So you submit an indication of interest, and since it's non-binding, there's no shop clause. The seller or the entrepreneur is going to shop around and be like, hey, I got a $20 million valuation for $5 million. Do you want to be the lead investor? I'll give you a board seat if you just up that to 25. right? Or you're trying to do a buyout, like, oh, this company offered me 50, you know, if you give me, you know, 55, right? I'm open to stepping down, right? Maybe the initial term wasn't like him stepping down. So it's like it gives them more leeway, right? On the flip side, what are the pros of, you know, starting with the indication of interest offer? Now, normally the difference is that an indication of interest offer, usually you can state a range. It's like something like saying like, hey, we think your company is worth somewhere between 20 to 30 million dollars. Well, we're not sure yet. We're still assessing that. Usually the variance would be like 10 to 15%. And then we can also state something like, we're thinking about having a board seat. You know, we're thinking about having an earnout structure or you know, this much in debt. What's the pros and cons of, what's the pro of having a ranged offer before you submit a official LOI?
It at least makes sure that the other party is going to be interested and within that range. But yeah, but then again, they're gonna. I feel like if you give a maximum or if you give a range, then the receiving side's always going to say, well, it's going to be the maximum or higher or something. But
Arguably, yeah. It could backfire, but if you find so many flaws in the business, you could always go the other way. And the exclusivity period in the LOI phase is where you gain the most leverage. So the whole idea is to kind of, you know, gauge interest, like you said, Vince. So what's very, very important, you know, when you're interacting, it's kind of like the beer test. There's so much psychology involved in these deals, more influential than any financial model, right? So you're trying to understand the motive of the entrepreneur, right? Like, what is he hiding? What is he thinking? Is he comfortable with this range, etc.? So as you buy yourself time and you open up, as Persia says, negotiations, right? Like you're finding if there's enough ZOPA, remember from our last class, zone of possible agreement, you're finding out if your reservation price and that person's reservation price allows for even a negotiation territory. If there's none available, then you just kill the deal and you move on. So this is a perfect example where I'm trying to assess the owner and how he or she thinks, right? So there's two different scenarios. One scenario, right, where we purchase 80% of the company. Another scenario where we purchase 95% of the company. The valuation is very, very similar. But the first scenario, you take 80% of the company, right? And you can make up to $6 million if you stay with the management team and you know, become like someone very committed on the sales side. The other option is you make 95, you sell 95% of the company, but your earnout is only $3.5 million instead. Which deal do you guys like better? By the way, if you're a 60-year-old seller, which deal do you think you would go for and why? I'll give you guys a second to think about it, and then I'll let you guys know what happened. All right. Any thoughts? A little bit more time, like a minute. Oops, sorry. Yikes. Do you guys see it?
Not yet.
Oh,
There we
okay.
go.
Okay. Okay. Good. Good. Yeah, Puya.
Yeah, so if I were like 60 years old, I wanted like the 95% because yeah, I want to exit probably, right?
You don't care for the extra 3.5 million,
Maybe.
or like extra 3 million you could potentially make. Okay.
It depends on my age, you know, because yeah, 6 years old. So yeah, I'm thinking about.
Anyone have any other thoughts? Anyone like the first one more? So to Puya's point, if you're maybe younger and you're motivated, right, to scale the company and exit again, so resell this business later to even a larger PE firm, right? So remember in PE, you could keep selling parts of your business as you grow, usually. Just kind of like how in VC, you keep raising money as you go. PE is like the opposite. You can keep selling as you grow. You'd probably want to opt for option one because you want to capture more of the upside, right? So doing a split offer like this, very, very uncommon. But you guys know me, right? I test out a lot of uncommon approaches. So I did a split offer, and obviously the owner is like 60 years old. He went for option two. I think it was even like a no-brainer. And he wanted a board seat. He didn't want to be, as involved, right? So that's where I, want to understand, because an owner, right, an entrepreneur can say one thing, but when you slide the term sheet and they see the financial numbers, it reveals what their true intentions are, right? So hypothetically, if I just skip to the LOI stage, I wouldn't know why he's selling. I wouldn't like, I am lagging the deal, which can introduce more competition, which could push the price up higher. But I sacrifice the efficiency of my deal structure because I don't understand what his motives are. Does that make sense? So if he chooses one of these two, I tend to understand like, oh, okay, he doesn't want to be actively involved, right? And why is that? Maybe he doesn't believe in the future of the company. Like number one would be indicative of saying like, oh, I believe in the future of the growth story. That's a lot more comforting for me. And then he also doesn't mind spending time to make the transition a little bit more smoother. If kind of like what Puya said, if he just wants to cash out as much as possible, as much money up front, that's a little bit worrisome. Because for me, it's like, has the business plateaued and he's just really good at covering it? Because you can always use that excuse as like, oh, I'm just burnt out. I'm 22 years old, but I'm burnt out from growing my startup. My parents told me to go back to school. I need to cash out. Like you could always use some excuse to maximize that, right? So for me, it's like always very important. My strategy is to usually do an IOI. And this is also maybe a confidence in my sales skills, that I feel like even if we don't have the best offer, if we're still within the range, we should be able to close the deal if we're a contender, for a deal that's pretty close. There's debt in this deal. We'll just talk about this a little bit more. Why is debt important in a PE deal?
Are you talking about how much debt the company already had, or how much they're bringing in debt to finance the acquisition?
The latter, Lai.
Oh, I mean, that is good because it reduces their taxable income and it gets basically allows them to buy out the company. It's the
Yeah.
win-win for them.
So let's take a step further. Let's not talk about taxes yet, but if you're paying 6% interest, right, on a senior note, but the company is growing 20% per year, should you take on debt or no? Probably, right? Your net profit is 14%, right, per year. So that's why PE is so attractive, because even if the company is growing, let's say like 10% a year, and it's like an asset heavy manufacturing company, and you can take out a loan to structure the deal with 30-40% debt, you can just sit on that company and it'll just grow organically without putting in much effort, just because of the difference in compound return versus the interest rate that you're paying, right? So by shaving off 3 million from this $12 million deal and subsidizing the deal with 25% or more in debt, we can increase our IRR, right, internal rate of return, and cash on cash return over time. So we'll talk about that in a little bit, because you guys are going to do some modeling this week, but we'll talk about that. But fundamentally, debt is very important in these deal structures. So let me go back here. Okay, so what does it mean when deal structure is oftentimes more important than price? What is deal structure, guys?
You're referring to the term sheet, right?
Mm-hmm.
I mean, it's more important because that's how you're going to conduct business with the company. And there are certain factors that are more important to you depending on your company.
So do you guys remember like Elon Musk's compensation, and when it was all over the news? If he hits certain milestones, he keeps getting all these additional stock options as a bonus by the board. Do you guys remember that?
No.
Okay, so basically, Elon Musk, if he hit, I can't remember, like if Tesla hits $500 million in market cap, he gets like 3% more stock options, and he kept hitting those milestones as Tesla stock was like just going off the charts. And then, it pretty much accelerated his net worth considerably last year. So he was not only getting the benefit of his stock in Tesla increasing in price, but he was just getting more stock options over time, right? So that is akin to what's called an earnout clause. And I'm sure you guys are familiar with earnout clause because I think we talked about it. But as a refresher, it's basically every time the company hits a certain, revenue or growth rate, the seller makes a bonus, right? So I'll give you an example real quick here. On another indication of interest. So let's see here. So this is a very simple earnout structure that's not in detail. Oftentimes it's a sliding scale, but here the owner gets 1 million if the company can reach 13 million in revenue by these dates every single time, right? So the earnout clause, sometimes what happens is that a seller might want a minimum of $20 million, and the maximum you're willing to pay is $15 million. And you can structure the deal in a way that, hey, I still want to pay you 20 million, but it has to hit these revenue marks by these years. And oftentimes it is the earnout clause is included in the total enterprise value of the transaction. So 1/3 of the deal could be, financed through cash, 1/3 through debt, and 1/3 through earnout. So they call these turns, right? Or I'm sorry, turns. It's like, 3 turns on the debt, 1 turn on the, earnout, and 1 turn on the, let's say, cash upfront. And this is basically what it is in terms of like when they describe like 5x EBITDA multiple, and it's like where the X is coming from, where the multiple is coming from, and how the deal is structured. So if you're really smart about structuring a deal, you could pay, you could leave the deal table negotiations, making the seller that they could potentially make more while you're mitigating your risk up front. Does that make sense? So if you're very smart in terms of structuring your deal, in essence, you can pay less, is what I'm trying to say. At the expense of speed, right? So it's a very, very tricky gamble. Now, in negotiations, first and foremost, the most important thing is price, but you cannot underestimate deal structure. So there's this one deal that I'm looking at right now, and he said the previous private equity firm didn't want to bring on all 4 of their co-founders, right? And it's like, well, what do you guys all do? Like, we all do sales. I'm like, okay, like, why do you guys have 4 you guys all do sales? Like, what the hell, guys? Like, they're all VP of sales, and there's like 1 CEO and then 3 VPs of sales, but they all do sales, right? And I could see why the former PE firm said, like, this doesn't make sense. Like, you guys all cancel each other. And for them, it was so important for them to stick with their buddies that they ended up killing the deal because they didn't want to even give a chance to the PE firms to decide which one of the sales guys they're going to keep, right? So, like, imagine from the PE side, though, you don't want, like, this isn't some, buddy kind of like fraternizing environment. Like, you want to make profits. So if any of the guys are bad at sales, like, you want to just keep the best too. You know what I mean? So I'm willing to look at that deal, but when I saw the roster, I was like, this is ridiculous. Like, why don't you have a COO, CTO, and CMO? You guys like have 4 chief sales officers. Like, this is crazy. But for them, it was super, super important. They get the right deal terms and they keep the team in sync. Working capital. What is working capital, guys? It's a layup. Anyone?
Basically, it's the capital that it's working, so.
What's the equation, Kuya?
Yeah, so it's current assets minus current liabilities.
Yeah, simple, right? So you're just trying to see, what the cash cycle is like at the time. And why would this be important, Kuya?
I think it just indicate that is the company able to, like, get to the needs, so do they have enough money to, like, for the day-to-day operation?
Right. So yeah, it's very important. So you're bringing in a new CEO that's never ran the business before, and first day he comes in, like, let's say he has like negative working capital, like he can't pay his vendors, and the operations just like stops, right? That'd be horrible, right? So this working capital clause is so important. This could sway the deal like 20-30% towards the end, because the seller point, like, he might not be making collections on his customers, or he's behind on payments, or, he, like, for him to start going through the due diligence process, if it's a small company, he might have kind of let go of the gas pedal on the operational side. So when it transitions to the new management team, there could be a bottleneck because of, I guess, like, illiquidity in general, right? So working capital is very sensitive topic, and it's something that is addressed. And then oftentimes there's an escrow account, or buyers will raise additional capital. So when they come in, they could prevent bottlenecks from happening. Because the first thing that you do when you do a buyout, you want to look at cash. Very similar to the VC space, like, you want to manage cash, but since you're getting a cash injection, it's coming from the opposite direction. Any questions, guys? Good? Okay. Let's talk about asset deal versus stock deal. So these are the differences. So you can reference the book, but I think this chart explains things very, very nicely. Buyers, want to have buyers want to do an asset deal. And why is that the case? What's an asset purchase like versus a stock deal? You're just buying the assets, right? Without taking in the liabilities. So of course you would just want to do an asset deal. Now it's not as easy as you think it is. It's a lot more nuanced than that. There's different rules in Canada. I think in Canada it's all asset deals. But what's interesting is that the multiples, whether it's an asset deal or a stock deal, stays pretty much the same as long as the company is healthy. So there's pros and cons of these tax rules that would sway the transaction going in one direction versus the other. And obviously deals are structured different. The tax consequences are different based on the country. But if you could figure, once you get into these stages, when you agree upon a price, that's when you decide on, the tax situation. And that's when you decide with the seller, normally whether you want to do an asset deal or a stock deal. But all in all, the core concept of this is that for the buyer, they want to purchase an asset deal because they don't want to take the liabilities, and for a seller, they want to sell everything in its form with the assets, liabilities, the equity, and all that stuff. So that's very important to keep in mind. Now, what's interesting is that, like, if a company is in terrible shape, it's like negative cash flow, the company is about to go bankrupt, etc. Without a doubt, it's an asset deal, right? You buy the website, you buy the customer list. In those cases, it's very different from structuring a deal as an asset deal for tax benefit reasons. That's just like a fire sale, right? So before after I left the company, my first company, Dealflix, 2 years later after I left, they started to spiral out of control ever since I left. And they tried to sell that company to my new startup, Cinemia. So my ex-co-founder was trying, after he fired me from my own company, he was trying to sell that same company to my new company, where I was the chief of biz dev looking at M&A deals. And the only way that this deal could have worked was if it were an asset deal. Eventually the deal didn't go through because he wasn't very honest about a few things. And that was kind of the case with my work experience with him before. It's funny, through all my ups and downs as a startup entrepreneur, because I've been through the worst of being fired from my own company and like bankruptcy to exiting and then having like a really amazing salary and writing a book. So I think there's only two times you really get to know someone. And the first scenario is when they're at the top, because they could do anything they want, or at least that's how they feel. So their true colors show, it just amplifies you because you feel so powerful. And the other scenario is when they're at the lowest pinpoint, the bottom. That's when you see their true colors again, because they'll do anything to survive, right? So I've seen both sides of this individual at the peak of his powers and at the bottom, like right before bankruptcy. And both sides, like, he's so shady. Like, when he's at the peak of his powers, he wants to not give any equity to employees, don't want to pay out bonuses. And then when he's trying to sell the company right before he's going bankrupt, he's like deferring payments to customers. So it looks like there's so much cash in the bank account. And then it's like, dude, are you stupid? Like, I lived in a van and visited all of them. I just have to like text them and just ask them like, hey, you received your payments for last month? Like, no, I haven't received the payment for 6 months. And that literally killed the deal because he was trying to hide it, but he didn't think like one step, because he's so greedy. You're so greedy and selfish that you can't think 2 steps ahead. Like, Kevin just needs to make a phone call. It's just, any one of them, and he'll find out very quickly. And he doesn't even have to pay a due diligence lawyer because his ex-customers are still all his friends, right? So it's a perfect scenario where we kind of joked around about this. Like, not only are you shady, but you're an incredible idiot. Like, you know, that's like the worst bucket, like shady and stupidity, right? So you're just it's like that one. You guys ever read that one story where this robber, burglar, like he tried to rob a house, and then as he was like exiting, he noticed there was like a laptop, and then he just wanted to check his Facebook real quick before he went out of the house, and then he totally forgot to log out after he signed in, and that's how he got caught. You guys ever hear that story? Yeah, it's so ridiculous. Yeah, so this burglar robs a house, and then he said, "Oh, there's a laptop. Let me just check my Facebook real quick before I escape." And then he just totally forgot to log out, and that's how he got caught. So I just think like some people they just don't think two steps ahead because they're so prideful or egotistical. So where am I going with the story? Yeah, so if a company is in bad shape, in that kind of scenario, in a startup, you might be in a situation where you're stuck, right? And you're thinking in your head, damn, my company, you know, and I get it. Like Dealflix was probably like people would have paid maybe $20 million for our company at our apex, but we didn't sell it. So now you can't even get like 200 grand, but you should at least go for 200 grand because for you, it's still an exit. It doesn't make sense to be shady to the last minute, hoping you can trick, you know, your ex-partner to get like $1 million because he wanted $1 million. I'm like, we can't even pay 100,000 for this. It's like, and then it's like when we gave him the terms, he wasn't honest with the payments, and the board just killed the deal. It's like he's not even someone we want to do business with. Even if he paid us to buy the company, we still wouldn't do business with this person because what he did to you and what he's doing right now is so shady. And it makes sense. Like, it doesn't make sense to hold on to your pride in that situation. And believe me, a lot of founders are like that. Like, money has a strange way of revealing people, and you see it on both sides, the super highs and super lows. And you know, to me, it's like money's money. It's not a big deal, but that's why I'm still in business and he's not. I mean, his last business was selling fruit juice at the farmer's market. That was his next venture. And his current one is just being a real estate agent. And it's like, dude, you went to Berkeley. Like, it's such a waste of talent. And that's that. And anyways, deleted from the annals of Silicon Valley history is his legacy. Okay, so enough. Well, any questions about this before we move on? I guess one other thing is an acqui-hire scenario. So this is basically when a tech company finds like 2 or 3 really talented engineers usually that wasn't able to monetize on their startup, but the technology is really, really good. They'll give them, you know, maybe like $1 million for the whole exit. So the investors get some money back in return, and then give the 3 or 4 engineers like really awesome bonuses and salaries to come work with them for 3 or 4 years. So that's an acqui-hire scenario, which is pretty common. In the PE space, it's not as drastic because you're usually buying a cash cow. So investors, when they make, you know, when it's a failed venture, it's like, oh, we put in $1 and we got 70 cents back. That's like a really bad scenario in private equity. It's not like, oh, we invest 100,000 and it went down to 0. It's just so rare for that to happen. So PE has the benefit of much less volatility, but you know, significantly less upside as we discussed before. Okay, so let's talk about form of payment, cash versus stock. What do you guys think is better? Is it better to get a is it better to, like, okay, let's just say, who wants to get picked on now? Oh, Enrique, does your mic work now? No? Okay. All right, we'll circle back.
Yeah.
Oh,
Yeah,
okay.
the headphones, I have no idea what's going on
Welcome
with that.
back.
Yeah.
Okay, so Enrique, let's say you are, this widget master company, and now your company's worth $50 million, right? You got two offers, right? So Logan says, hey, I'm from, company Logan X Ventures, and I'm gonna buy your company 100% stock, right? And then Persia comes in, she's from Persian Y Ventures, and I'm gonna just give you 100% cash. It's very binary. It's one or the other. What are you gonna pick? 100% stock or 100% cash? And how are you gonna think through this, and what are the things you're gonna look into before striking a decision?
I feel like it depends on what you are trying to do afterwards, no? Like
Let's
if you
say
need
you're just
money
trying
for
to-
something else.
Let's just think that I can see where you're coming from, right? So if you're trying to do another venture, maybe you want the cash up front. But
Right.
let's just say for the deal transaction itself, and you're just trying to maximize your return. What are some of the things that you will look for?
Like if you believe the company is gonna grow more in the future, you might want to do.
Whose company? Your company or the stock that you're getting from?
Yeah, the stock.
Right. So the easiest way to think through this is that, like, if Logan, right, was Logan the one with the stock? Did you offer the stock, Logan? Or did you offer cash?
I think I was the cash.
Oh, okay. So Persia, right? Her stock is like, let's just say like Google stock, right? Would you, and then Logan is just 50 million cash. Would you want to get Google stock? Or do you think there's a better opportunity cost? Or what was the hottest stock, like Zoom of last year? Persia's like company is Zoom. Zoom wants to acquire you because they want to buy widgets.
And is it the same amount of stock as in cash?
Yeah.
Man, I think I might rather go with cash and try to invest in something else.
Really? Oh, but let's say there's no other, like, it's like the top percentile. Okay, then let's just put it this way. Let's say Logan, right, is what's a stock that did horrible last year? What's that Carnival one? CCLV?
Yeah.
Yeah. Let's say he's just American Airlines, right? This is 2020. You're 2020, right? He offers, $50 million with American Airlines stock, right? Persia offers $50 million with the Zoom stock. What do you go for?
I would go with the American Airlines.
Why would you go with American Airlines?
I don't know, maybe I think like you go long term and it'll grow back in the future and you get it in the lowest point.
Oh, I see. Okay. But the basis of this exercise, right, is to first and foremost, I guess your intentions are what matter the most. But if you're going for the ROI, you're trying to weigh what you can get the cash and what to invest in versus that company's stock, right? Also, there's tax benefits into just rolling your stock, right, into that newly acquired business. So you don't pay taxes. Like if you get it in cash, you have to pay like 30-35% cash. But if you're getting it stock, you defer that as long as possible because you're just exchanging your widget stock into Zoom stock, for example, right? So there's taxes that could really shift the direction of your deal. So it's case to case. Sometimes you want a combination of both. So let's just look at two scenarios, right? So Square acquires food delivery service Caviar. This is 2014, 90 million, pretty much all in stock, right? Another one is AMC buys Carmike Cinemas, $33.06 for all the shares outstanding, right? So anyone want to take a guess what happened afterwards? If you guys look at the dates. So one's 2014, this one is 2016. So a couple of years apart, right? But We could, and then we'll look at the history of the stock. So imagine you're a shareholder of both companies, right? What company do you think outperformed?
Probably Square.
Probably Square, right?
Okay.
So this is actually a trick question. I use this example, but I recently realized this example no longer works because of the whole Robinhood movement. So this is what it looks like, right? But the key I like to emphasize on the AMC is the $2.12, not the Wall Street Bets movement that made it like $60. And turned the market cap into like 20 billion plus, right? So AMC, like if in 2021 at $2.12, it was worth $500 million, 500 million, when the deal itself was worth $1.2 billion. So the acquirer was worth less than the acquiree, even though AMC was significantly like a 5 times bigger company at that time. So it's fascinating to see if you were at Square, right? And then, or you were at Caviar and then you got Square stock at the time of transactions, you would have at least made 40x your money, 40x. So that $90 million exit is like a $3.6 billion exit, basically. That's the power of sometimes these stock options. So that's one of actually my LPs, Jason Wayne. He shared with me a story in more depth. So I asked him, wait, then if Square knew, right? So as a seller, or I'm sorry, as a seller, yeah, as a seller, if a company is doing hot, you definitely want that stock, right? But it's kind of like raising equity versus cash when you're buying a company. You don't want to give away your shares because you know it's going to go up, right? So can anyone take a guess why Square bought Caviar with stock at the time that they did? Because I'm sure, you know, with Jack Dorsey and, you know, having some guys from the PayPal Mafia group invest in Square, they knew the company was going to go up like crazy, right? Well, in that scenario, why did Square buy Caviar in stock when they should have just paid in cash? Because this cost them $3.6 billion basically, opposed to 90. Looking at how much appreciation they had over time, right? Why would they do that? Or why did they do that?
Maybe they were running low on powder, so that's the only option they had.
Yeah, right, that's correct. Very simple answer. They just had no money at the time because they were a startup too. So very, very expensive transaction for Square. Very, very lucrative transaction for Caviar. So in Silicon Valley, a lot of these nuanced things happen quite a bit. Okay, any questions? So this is different from an asset purchase and a stock purchase. This is how the transaction is paid, cash versus stock. So let's talk about conditions to close. So usually, you know, when you're trying to close a deal, there's certain things that you have to look for. It's always subject to board approval. So Persia, after you send in the LOI, you have to ask your board members and your LPs if they want to participate or not. Working capital, you're going to look into that to make sure, you know, you're in a good situation, and you're not going to, you know, default on any payments or cause any liquidity issues. There's a no shop clause. Fees are more expensive for smaller deals. What I mean is that, like, you know, normally on a $10 million deal or $30 million deal, the lawyer fees are like marginally different, like 200K to maybe like 250K. So the percentage that you spend on a smaller deal in legal fees is so high relative to a medium size or a larger size deal. So oftentimes, you know, situations like this like makes investors not want to participate. agencies costs and information asymmetry. Sometimes, owners and even tech entrepreneurs are not really sophisticated in their finance skills. So you have to spend your own time reconciling that. So ask for, I guess, like contracts, ask for maybe access to their QuickBooks, maybe their Stripe account, how they're collecting money from vendors or their customers. That actually helps a long way. And during the due diligence phase, there's ways to outsource nowadays where people, like, for example, in developing countries like India or the Philippines, will do like a preliminary like due diligence, industry research, all that stuff for just like $100. It's pretty crazy. So as a litmus test, it's might be very beneficial to outsource some of the due diligence processes, because in the US it might cost like $50,000 to do the same amount of work, where you can outsource it for like the whole entire thing for 1,000. Now the quality of work is probably not as good because they don't understand the current, like the markets where you are at particularly. But it's a good way of just gauging if it's worth spending 50 grand by spending, maybe $500 initially to hedge that. Also on the tech side, you could do the same thing. Make sure like the code is straight, it's scalable. Sometimes legacy software, they might use like really old languages where engineers this day and age won't even know what to do. So you're going to spend all this time fixing the code, not building the code. So that's very important to understand when you're looking at companies. So this is not it. There's actually a little bit more, but we'll take a quick pause here, and then I want to just go over your homework assignment. So let's just take a quick 3-minute break, or let's get back at 10:48, and then we'll just go over the homework assignment real quick and expectations, and then I'll give you guys some break time to submit just a quick 1-pager on what you want to do with your PE and PE or VC firm. Okay, so see you guys at 10:40. Okay. And we are back. So, so we're going to use a very similar template for this week's homework. But the difference is you're going to, what I'm going to do is I'm going to give you guys financial statements of an anonymized company this time, and additional material that you can look through, probably like a brief presentation about the company, and some of their financial statements, but all X'd out, or the company name. And then based on what you see and based on macro research that you do, I want you guys to project the next few years, right? So this is very different from the multiples method that you guys did, where you're looking at publicly traded companies and looking for comps. You're assuming, you know, certain growth rates, right? Then I want you to assume certain levels of the cost structure. So let's just go here, return analysis, or I'm sorry, is it assumptions? Yeah, assumptions. Try to figure out what percentage of the company you want to fund via debt. And for some reason, like this is slightly off. I'm not sure why it's not transferring over. I might have to bug Elena about it. But if you're going to increase debt, right, obviously the common equity is going to go a lot lower. So let's say this common equity is a lot lower, and then you just like increase the debt here. What ends up happening is that in your return analysis, your IRR changes significantly, right? And you go over here, under assumptions, this is a base case of 120%. So let's just say 90. And then I'm just going to use downside scenario 3, or let's just do 2. So your upside is 50%. Make sure you watch the IRR and cash on cash video so you understand what you're looking for. But you want to, it's still really high. That's because I got rid of the earnout clause and the debt component is really big. So let's just go with this 10%. Oh, it's too low. Okay. Upside, let's just do 25%. And then we'll do case 2. Okay. And then return analysis is 109% and then 9.1x cash on cash returns. The reason why this is so high is because you're paying, let's say, 6% on debt. And then you finance 40% of the company in debt. But let's just go back here and assume you're just doing pretty much an all equity type of deal. And then the senior debt is 0, along with the seller note being 0. And then you probably finance the debt, let's say just like $5 million, right? In that scenario, same transaction size, but now your IRR is no longer 109%. It went down to 54%. And obviously, right, because you financed most of the company in cash versus equity. Does that make sense? So you want to structure this deal, including an IRR, being aware of the IRR and your cash on cash return, right? So play with this analysis, right? So you're going to go over, so for example, this is an EBITDA multiple of 5.5, and you're going to decide on what kind of multiple that you pay. So look through the transaction expenses, like how much cash, total transaction cost, transaction value, along with the expenses and the EBITDA multiple. Then you go into the assumptions and you build out the assumptions here, your gross margin, SG&A expenses. These are the only things you have to worry about, the revenue growth rate. Try to do a scenario analysis. And then if you feel like the numbers, right, are not necessarily going to be a steady growth rate, you could just manually input these numbers, right? But the goal of this exercise is for you to come up with your gross margin, operating expense margins, EBITDA margins, so that you can assess what the value of the company is going to be, and you're willing to pay for it. Now, the interesting thing about this example is that a lot of industries post-COVID has shifted quite a bit. So when you're putting in your footnotes, and let's just say you have like COVID, like let's just say COVID 2020 trends in fintech, right? So fintech growth rate. So let's just say you find a really interesting article like this that shows why a fintech, let's just say hypothetically, right? You find out why the fintech industry is going to be really, really hot. And let's assume this is a fintech startup. Make sure you put your assumptions like this. You put your footnote here and you put a reference point, and then you put footnotes, and then you put, you know, one assumes changes due to COVID. Then you put your article here. So that's the one thing I don't like about this template that Elena created. I'm a huge assumption person, and your assumptions need to be, I need to know why and how you came up with the valuation that you did, and verify the source of that accuracy. And investors always want to see this, not just the numbers that you input, how you came up with the assumptions. Make sure you annotate that at the bottom and in this particular format. So let's just say your gross margins, you don't agree, so you could just put something like gross to you could just put something like that, because if something is off and you manually overrid the assumptions, you want to make sure that's embedded in here. Does that make sense, guys? So don't just follow and just punch in numbers. Look through these numbers very, very carefully. And you don't have to worry about the pre and post dilution option pool. It's just going to complicate things. Focus on the growth rate and you know, downside, upside, base case, and how you build those assumptions and how you're backing these numbers. And then what you do is you find out the EBITDA multiple to come up with your total enterprise value. Then you come back with restructuring the deal with the sources of cash here. Just focus on senior debt and seller note. It doesn't matter which combination of senior debt and seller note that you per se do create right here, as long as the cap table is 5.5. This should be 5.5 million, not 50. So I was just fixing that right now. As long as the transaction, the sources of cash matches up the total enterprise value, make sure that matches. Then on the return analysis, you're gonna be able to see different IRRs, right? Now, if you're giving out earnouts, this affects your IRR. So you have to put in, let's just say, in this case, like you're paying someone $1 million if it hits certain revenue marks, and then the next year you're gonna pay him like $1.5 million, and then the following you're gonna pay him $2 million. So if you're gonna do earnouts, it should go here. So this is common new for seller, and then this is seller. So this is where the earnout input you would put in to see how it affects your IRR and cash on cash return. Once you're done with that, you're gonna create an IOI, right? Or if you want to go straight to LOI, I'll give you the option to do that as well. Think about a strategy you want to bake in, and then you're going to submit a letter of intent or an IOI, whichever you feel better about doing. Doesn't really matter per se. So where's the letter of intent? Oh, here it is. So I'll give you guys a template of what a letter of intent looks like. And then you're going to structure the deal, summarize it, disregard the equity pool option. You don't have to calculate it, but it should be in there, even if it's 0%. And then you're going to put terms in here as you feel fit. to finalize the deal and submit a term sheet or an LOI with terms. Any questions, guys?
So in case of entry and exit multiple, is it fixed or?
No, it's never fixed. You could make it the same, but it's up to you.
Yeah, I mean, is this a new company? This company that you just showed us? So
Yeah, you're gonna get a separate SIM and a package with
Okay.
financials, and you're gonna build off of that.
yeah, and do we need to like buy 100% of the company or?
It's up to you. So there's two parts of this, right? Where you analyze what you think the valuation is, or three parts. Then you structure the deal, right? And then you submit an IOI or an LOI, and you can decide, do you want to buy 80%? You have to get majority, you have to buy at least 50% though. That's the rule, because this is a PE buyout. And then you could buy 95%, 100%. You could do an indication of interest where you do a split offer, or you can do an LOI. Whatever you think is how you would proceed with this type of deal once you read through the documents. I'm also going to add notes about the seller, what kind of person he is, what kind of job he has, so that you get an idea on how you would approach this particular deal. Let me just write this down. Financials, deal structure, IOI or LOI. Yeah. And what else do you have? Unless you want to do the same sim, but no, we should do something else. Any other questions? It sounds easy, right? You guys can do it. That sounds too hard.
Sounds good.
Sounds good.
Sounds great.
Okay. That's great. I know you guys can do it. Okay, so we're gonna do breakout rooms. And let's I'll give you guys, and then I'll post on Canvas. Just give me like a one-page summary. It could be double spaced on what you're thinking, like the stage of the company, what industries, what companies you might be thinking about, just to make sure you guys are in the right direction. So we could do maybe breakout rooms for like 20 minutes till like 11:20. Would that work, guys? Okay, so I will create breakout rooms. Oops. So you guys could pick your own breakout room.
send it to you. I will
Hey
send.
guys,
Okay,
hey,
what's up?
anything I can help?
Um,
We just
well, we are between industries. So as we talked yesterday, we want to like go with maybe 3 industries, and we can like pick one company from each industry. Is it?
Okay, let me